Hey, what's going on, guys? Today, I wanted to just talk about diversification. Should you be diversifying your crypto investment and how I personally go about managing my portfolio, as well as some client portfolios that I help consult or manage? We'll go over two different school of thoughts, like the Buffett style of investing, where we're kind of concentrating our bets, picking a few potential winners, and kind of hold on to these assets long term, and hopefully they outperform based on our analysis, right? And on the other side, we'll look at the Ray Dalio approach of the all-weather portfolio, where we're kind of spreading our bets in like different industries, different asset classes, and protecting our portfolio while getting a modest growth rate as well. And if you're new here, my name is Richard. I'm a DeFi investor and a yield farmer, and I do work as an investment consultant and manager as well. So I know a little bit about investing, and hopefully you get some value out of this video. And like always, this is not financial advice. This is what I personally do. And this is the topic that I sometimes talk with like either clients or students in our Drippy finance community. And your approach could be completely different, right? Which is completely fine, because your approach should match your own investment style, your investment edge, and like your personal risk tolerance and your market outlook, right? So the first type of investing is what I call like a Buffett-style investing, where we're betting more heavily when the odds are in your favor. We invest into things that we understand, where it's within our circle of competence, right? For example, if I'm very into crypto or I'm very into DeFi, I'm not going to spend too much time looking into or investing into like AI stocks, for example, just because I don't know enough about those stocks or about that industry to be making really good investment decisions. So if I'm using this approach, I'm investing into things that I really understand, right? And with this approach, we're also trying to find undervalued assets or assets that we believe would grow long term that still has a lot of room to grow. So oftentimes with this strategy, we're not trying to find like the hottest stock. We're doing the opposite, right? We're finding like the undervalued assets that some people may not have like looked into, or assets that are just kind of flying under the radar and have like solid management, solid fundamentals, and stuff like that. So there are a couple good things about this strategy is you can make a lot of money if you're right. For example, if you bought Solana when it was under $10, you would have made a ton of money, right? And it could be great if you have an edge in the market, if you know deeply about a specific topic, or you've just been in the industry for like a very long time. And it's really great for wealth accumulation, assuming that you could get consistent returns over like the next 5 to 15 years. And when I say consistent returns, I don't really mean like, okay, you're going to make money every month or even every year, right? But over a longer time span, like over, let's say 10 years, you're consistently outperforming, for example, the S&P 500 if you're investing into stocks, or you're consistently outperforming stuff like Bitcoin or Ethereum if you're into crypto. But there are a lot of downside with this type of investing as well. For example, you could lose a ton of money if you're wrong about a particular investment. If you look at like the different interviews of Warren Buffett or Charlie Munger, you would know that when they started out, they do bet pretty heavily on different assets that they believe in, and they didn't really diversify that heavily, right? But history could have easily gone the other way if they picked like the wrong companies to invest in. And if you're not a full-time investor or you're not that passionate about investing, you don't really want to like read the fine prints. You don't really want to look into like the specific details about the project. Or if you're yield farming with DeFi, you don't really want to read the docs that much, right? And you don't want to look at the team. You don't want to watch like the founder interview. You don't really want to like talk to the team or anything like that. Then this type of investing is probably not for you, simply because you do need to do a lot of work to get into the right investment. And it is a lot of time commitment, because a lot of these guys, they really like investing and they're betting the amount that they could lose as well, right? If you watch the interview or you've read some of the Charlie Munger's book, for example, then they did have money to invest and they're actually comfortable to like take that risk, right? For example, people like Charlie Munger, he had like a law degree. So even if his investment didn't really work out, he has something to fall back into, right? So that puts him in a situation to take more risk as well as an investor, simply because if you had a family to feed and you're struggling to make ends meet, but you're also taking a ton of risk when it comes to investing. Sometimes you just can't afford to take that loss, right? Especially if people are counting on you. If you're buying a stock and it goes down by 90%, you lose like your life saving, then this type of investing might not be for you, especially if you're already very busy to try to make ends meet, right? It's a lot of competition as well, especially as the market matures. In the crypto market, we're often competing against insiders. And if you have an edge in the market, you could be using this type of investing. But oftentimes, if you realize that, okay, your edge might not be real or that some other people might have more of an edge, so then this type of investing could actually underperform over time, right? If you actually don't have an edge, you don't really know what you're buying, and then these assets that you pick, they don't really outperform the wider market either. So it's going to be really hard, especially if you don't have an edge or you don't have any expertise in the market. And it's going to be very hard to hold through the drawdowns if you need the money, right? You got to have the room to actually buy these assets and hold for a very long time in some cases to be able to see the returns for these projects. And this is the other type of investing that I want to share. If you don't know who Ray Dalio is, he's a very famous hedge fund manager. He's famous for a couple things. One of them is the all-weather portfolio. Basically, a quick recap of that is he spreads like the funds into different asset classes like stocks, bonds, gold, and stuff like that to protect the portfolio and to see growth long term, right? Because if you analyze different markets like gold and stocks, sometimes they are correlated, but oftentimes they're not correlated. As long as these assets move up and to the right over time, then you actually don't want too close of a correlation, right? Because if stocks goes down by a lot, but gold either stays flat or kind of drift up a little bit, it kind of protects your portfolio from a really sharp drawdown. And it is less volatility and less downside risk if you're spreading your assets into different assets. For example, you're buying some real estate, you're buying some gold, you're buying some stocks, you're buying some crypto. And if these assets go up in value over time, you're going to make money over the next, 5 to 10 years, 10 to 20 years, right? So this type of investing is really good because you could lose less money, especially if you're not an active investor. It's great for wealth protection. If you guys have more than like 100K in investment, I personally would be more comfortable diversifying my portfolio into other investment and not just keep it all in crypto, right? Because crypto, as much as I like it, there's a lot of mistakes that could happen in the market. And sometimes the market is just weak. So it helps to have other investment to not feel so bad about like our active investments if we're combining both approach, right? And I'll talk about that a little bit later on, but there's less chance of losing money long term. I've heard of a ton of people that went with like a heavy investment approach. They went all in into crypto, but then they lost all their money in crypto, right? And this could be especially bad if you don't have a high income, simply because it could take you like years to make back the money that you lost, right? Or if you're taking a loan against your house to buy crypto, then that could like elevate the risk by quite a lot, because if the market doesn't perform the way you want it to, you could be underwater and then, you could lose your home even, right? So I've heard of a ton of stories of people losing almost everything or everything through crypto. So this is where you got to be really careful and you got to know yourself. But if you're comfortable in taking that risk, then that's on you, right? Maybe you're young, you have a high income, maybe you don't have a family to support, then maybe over diversifying might not be for you. But if you want to be more passive, you want to focus on your business or career and not spend too much time like diving deeper into crypto, because you got to spend time to look at what you're investing in, right? If you want to be more passive, then it's always a good idea, in my opinion, to diversify your portfolio, because you could make less mistakes that way. And you can invest into index funds like the VOO or the SPY for the S&P 500 ETFs, right? And then your portfolio would have less drawdown as well. A lot of people that invest into altcoins, they're already very high risk takers, but you might not actually know yourself well enough to be able to hold through that 80 to 90% drawdown, right? Sometimes those drawdowns are quite aggressive. And even though I've been in crypto for a while now and I'm not even 30 yet, I have other investment. like a pretty big drawdown also feels pretty bad, right? Because we see like our portfolio hitting like a new high and then comes back down to be like pretty low. So having other investment definitely makes it feel more comfortable and then makes it less likely that you're going to be selling these assets at a cheap price. When prices are going down, when they're cheap, that's when we should be buying more of those assets rather than doubling down when the prices are already high and then we're seeing our portfolio rising higher and higher, right? But with this strategy, there are also some downside. There's slower wealth accumulation. So if you're trying to like be an active investor, your capital is not going to be as efficient, especially if you're doing stuff like farming different airdrops and stuff like that. Then maybe it could be worth it to like put more into crypto. And it could be better to make more concentrated bets if you are a full-time investor or have an edge in the market. And it all depends on how you define an edge, right? For example, back in like 2021, 2022, I was flipping some NFTs for a nice profit. I also got some airdrop from the NFTs. I spent like a couple $1,000s to get into like a private NFT trading community. That community no longer exists, but I did have like a pretty good edge in the market. I knew what I was doing. I was making like a couple $1,000s at times, but I also lost quite a bit of money when the market crashed, right? But I did make a decent return because I had an edge in the market. And I also had a lot of time like sitting in front of my computer. So that could mean that active investing in that scenario and not over diversifying was better for me. But it's really hard to tell like which strategy is going to outperform. You kind of need to like know yourself and just be comfortable taking on that risk, right? In investing, returns are never guaranteed. We could follow like, okay, what are like the best strategies that have done well in the past and are likely to do well in the future, but it's never guaranteed. And it's less capital efficient again for active investors because if you could consistently make returns with active investing, you don't really want to be like spreading your bets too much, especially if you don't have a large portfolio yet, right? And I personally use a mix of both strategies. And I believe that this approach is best for most investors that are looking to be a bit more active in crypto. Maybe you're looking at different investments like Hype, Solana, or different lower cap altcoins or DeFi investments like Pendle or Arrow. Then you could actually be a bit more active, keep up with the project, read the docs, right? You still want to like take the time to research those projects. Most investors don't. That's why they lose money long term. But if you actually put the time in, you do have a pretty good chance of succeeding. But I also diversified into other investments simply because if the altcoin market is pretty weak, like what we were seeing since like the beginning of this year, then our returns could be either flat or negative sometimes, right? So as an investor, sometimes you will have a down year. That's completely normal. But over time, we're accumulating more assets and hopefully outperform the market. But I also diversify into other assets as well as diversify my strategy. The reason why, again, is because if you don't diversify and you fail at like active investing, you don't really have anything else to fall back on, right? I'm personally trying to get married soon. And I do want like an investment portfolio that I could count on over the next 10 to 20 years, even if some of my active investments don't work out, right? So that's kind of how I think about it. And I also want to talk a little bit about the diversification of strategy here. So if you guys are yield farming like I am, you should be using a mix of different strategies, right? Simply because we can't tell the future. We don't actually know like which strategies are going to outperform or not. The first strategy that is very simple that anyone can do is just a simple like DCA and hold, right? You could be buying stuff like, for example, Bitcoin and Ethereum. Just buy and hold those two assets for a very long time, like, 10, 20 years in the future. If you believe in the asset class, that's a very simple strategy to implement. And I believe that is still very important as yield farmers to be buying these assets over time. We want to be accumulating assets, especially if we're building our portfolio rather than like be a net seller or trying to swing trade too much of these assets, right? So that's the first strategy that I do. And the second strategy is the blue chip LPs. And when I say blue chip, it could mean very different things for you, right? But for this, I'm talking about stuff like Ethereum to USDC, for example. And if you're comfortable with Solana or Hype, then you could be like providing liquidity for stuff like hype to USDT or SOL to USDC, or do like crypto to crypto pools, right? Like hype to unit ETH or hype to UBTC. Those are all possible options for like the blue chip LPs. And then the smaller cap altcoin LPs, you can do that as well. So because altcoins have been pretty weak in 2025, this strategy hasn't really performed that well. So you could be down on a lot of your altcoin investment, and that's totally normal if the market is down, right? Like with the liquidity pools, you have a long exposure in the market. So even if you're earning fees, sometimes the fees would not cover the asset depreciation. So that's why it's very important to have a wide variety of strategy. So even if you lose money with the altcoin strategy, at least you're still making money or actually accumulating assets with these other strategies, right? And then the last strategy is the stablecoin lending. You could be lending your stablecoins in different platforms like Aave, or depositing into vaults like Morpho or whatever other vaults. Or you could be using yield arbitrage strategy with different platforms like Contango, where you're leveraging up on these assets. But of course, with leverage, it comes with more risk. You could do like funding rate arbitrage or delta neutral strategy, where you're basically finding like the difference in the funding rate, or you're trying to, like, for example, buy some ETH, stake that ETH, and then short ETH to earn the funding rate, right? As long as the funding rate stays positive, you'll be paid the yield from that funding rate and then also the yield from the stake ETH. So that's something to also look into if you prefer like these delta neutral and stablecoin strategy. And we could also be airdrop farming at the same time, or doing other active strategies, like for example, making content or just working for different projects in crypto, either through like freelancing, consulting, or just as a job, right? So all of these options are going to give you a more consistent return from crypto rather than just going all in into one strategy. And before I hop off here, the reason why I really like cross-asset diversification is we never actually know, okay, which assets are going to outperform in the next decade or so, right? Of course, if we zoom out like really far, you can see that ETH and Bitcoin has basically outperformed like most other traditional investment. But many of us didn't actually get in back in 2017 or earlier and then hold all the way up here, right? And I've heard of a lot of stories too of people that got in 2017, they sold too early and then never got back into the market. So it's not like very simple where you just like, okay, you're taking like a lot of risk back here when the technology is quite new still. There's not a lot of adoption or clarity. And then you don't make another bad investment after that, right? There's a ton of stories of people that got into Bitcoin early, but then they lost money over time simply because they made a lot of other bad decisions along the way. And the reality is, if you got into Bitcoin very early, you're probably a risk taker. And if you take too much risk, sometimes you could just lose a lot of money. But if we kind of measure from like the bear market lows, you can see that like ETH and Bitcoin has been outperforming for quite a long time, right? Until this cycle, if we measure from like the peak to peak, you can see that Bitcoin is still up about 80 something percent from the previous high, 70 to 80%. But if we're looking at Ethereum, it's still down about 7%. Of course, if you do stuff like staking, or if you're providing liquidity like I am, right, then our returns is going to be much higher than this. For example, I have a client portfolio that got in at roughly $3,300 ETH in 2024. And then after I helped them manage and consult, they grew their portfolio from 150K to about 230K, right? And ETH is currently up less than 20% from 3,300, right? So we did pretty good with that portfolio, but we never know what the investment return is going to be in the future. Maybe if the pattern follows a previous cycle, ETH would outperform Bitcoin, right? And then kind of catch up to Bitcoin a little bit. We'll have to see how it goes. But the reason why, again, I like diversifying is because you never know which assets are going to outperform. You see a huge run in gold. A lot of people actually did not buy any gold for a very long time, because if you actually zoom out, the gold chart was quite flat compared to the S&P 500 for quite a long time, right? The S&P 500 did really well as well. So did QQQ, which is made up of mostly tech stocks, right? But if we kind of tick off the crypto charts here, you could see over, let's just say like the last 10 years here, tech has basically been outperforming the broader market for a very long time. And the second best asset is S&P 500 and gold. But again, it depends on the timeline that you're looking at, right? Gold is this yellow line here. If we kind of adjust the chart a little bit, you could have easily argued that gold was a bad investment because over the span of 10 years, it's kind of just flat, right? It only made like a 50% gain, but then it suddenly had a huge run up. In my opinion, it's very hard to like, okay, predict which asset is going to keep outperforming or which asset is just undervalued in general. So the best approach for most investors, in my opinion, is to just buy a lot of these solid assets that tend to outperform on longer time frame. And again, that includes stuff like Bitcoin. And if you want to dive deeper into like altcoins, then stuff like Ethereum or maybe even Solana and Hype, if you're kind of going down the risk curve, right? And then you also want to be buying different assets like gold to kind of make your portfolio like more resistant to any like drawdown or to a bad economic condition, right? Sometimes the drawdown is going to be really uncomfortable, especially if you're buying assets that are already up by a lot. But yeah, that's pretty much it for this video. Again, it all depends on the individual investor. So if you have a lot of time on your hand and you have an edge in the market, active investing could be really good. But, using a mix of strategy doesn't really hurt either. You could do both like diversifying and also active investing. And then if you're providing liquidity or investing into DeFi, it's always a good idea to have a wider set of strategies rather than relying on purely one strategy in case one of those strategies don't actually do well long term, right? So hopefully that was helpful. And if you guys want to learn more about investing in DeFi, we go over stuff like portfolio building, risk assessment, all of that stuff that I've learned from like being really into investing. You could check out the link below in Drippy Finance, and you'll have access to our Discord as well to ask me questions. And the lifetime membership is limited. Probably will cap it as like the first 100 members. So if you're into DeFi, you can check that out. There's about 5 to 6 spots left for the early access. I'm capping it for now because I want everyone that joins our community to get a good experience. But everyone that got in so far was pretty happy with the course. So if you want to check it out, the link is down below. And again, if you don't want to, and if budget is an issue, just keep an eye on my YouTube. I post these videos regularly, and I've released over 100 free videos on YouTube that goes over DeFi, yield farming, and investing, right? So keep enjoying that. And I will be running more free workshops in the future as well. If you guys follow my X, I will be posting on there if I'm running free workshops in different communities. You can join that and ask me any questions there. But that's pretty much it for this video. Thank you once again for watching. I'll catch you next time.